Something strange is happening in the silver market right now, and most people are getting it completely wrong. Silver just dropped to around $78 an ounce, and across social media, across finance forums, across comment sections, people are calling it a crash. They are panicking. They are saying silver is done, that the rally is over, that the metal has lost its shine. But here is what I want you to think about before you make any decision based on that noise. What if the $78 dip is actually one of the most misunderstood moments in the silver market in years? That is exactly what we are going to unpack today. My name is John Smith, and welcome back to the channel. Before we get into it, this video is not financial advice. I am not telling you to buy, sell, or hold anything. What I am doing is helping you understand the bigger picture, the macro forces, the geopolitical context, the market psychology, so that you can think more clearly about what is happening and why it matters to you as an investor, or as someone who cares about where the economy is going in 2026. Let me set the scene, because context is everything when it comes to silver. Silver is not just a shiny metal that people put in jewelry or stack in their basement. It is one of the most industrially important commodities on the planet. It is used in solar panels, electric vehicles, electronics, medical equipment, and semiconductors, and demand for all of those things has been growing. At the same time, silver is also a financial metal. People buy it as a store of value, as a hedge against inflation, and as a safe haven when the world feels uncertain. So silver gets pushed and pulled by two completely different sets of forces: industrial demand on one side and financial sentiment on the other. Right now, both of those forces are being hit by the same two things: the U.S.-China trade talks and what analysts are calling macro-liquidity pressure. That is the heart of what we are exploring today. Let's break this down starting with the trade talks, because this is where the story really begins. For most of 2025 and into 2026, the relationship between the United States and China has been one of the defining stories of the global economy. Tariffs, restrictions, negotiations, counter-tariffs, and ongoing back and forth sending ripple effects across virtually every market on Earth. Silver is no exception. In fact, silver might be one of the metals most directly caught in the middle of this tension, and here is why. China is the largest consumer of silver in the world. When you add up all the industrial use cases, solar panels, electronics, manufacturing, China accounts for a massive share of global silver demand. So when there is uncertainty about whether U.S.-China trade relations are improving or deteriorating, the market starts asking a very important question. What happens to silver demand if the trade environment shifts? If tariffs get worse, Chinese industrial production could slow down. If it slows down, silver demand from that side of the equation weakens, and if demand weakens, prices fall. That is the basic logic the market is running right now. But here is the thing, that logic, while not wrong, is also incomplete. And that incompleteness is exactly where the trap gets set. The recent U.S.-China trade talks in 2026 have been producing genuinely mixed signals. There have been moments of optimism, where both sides appear to be pulling back from the most aggressive positions. And there have been moments of friction, where new restrictions or retaliatory measures get floated. Every time there is a positive headline, markets breathe a sigh of relief. Every time there is a negative one, risk assets sell off. And silver, which straddles both the industrial and financial world, tends to move sharply in both directions. What happened around the $78 level is a perfect example of this. There was a window where the trade talk headlines turned negative. Reports of stalled negotiations of both sides digging in on key issues hit the wires. The market read that as bad news for global industrial demand, and silver got hit. At the same time, and this is the part most people are missing, the financial market environment was already under pressure from something entirely separate, something called macro-liquidity pressure. Now, liquidity is one of those words that gets thrown around a lot, but let me explain what it actually means. Think about liquidity as the amount of money flowing through the financial system. When there is a lot of liquidity, central banks are printing money, interest rates are low, credit is easy, investors feel confident. They put money into all kinds of assets, stocks, bonds, real estate, and yes, silver. Prices go up. When liquidity tightens, central banks are pulling money back, rates are higher, credit is harder to get, money starts to flow out of riskier assets. Investors get more cautious, they move toward cash, toward safer government bonds, and they reduce exposure to things like silver. In 2026, we are in a period of significant liquidity pressure. The Federal Reserve, after years of fighting inflation, is navigating an incredibly difficult balance. Cut rates too fast, and inflation comes back. Keep rates high too long, and economic growth gets choked off. Other central banks around the world are dealing with their own versions of this same problem. The result is a global financial system where liquidity is constrained. Money is not flowing as freely as it was a few years ago. And when liquidity is constrained, silver gets hit from both sides. On the industrial side, tighter financial conditions slow down business investment. Companies are not building new factories as aggressively. Solar installations face financing challenges. Electric vehicle rollout gets tempered. All of that reduces near-term silver consumption. On the financial side, when real interest rates are positive, meaning safe assets like bonds are actually beating inflation, there is less incentive to hold silver, which pays you nothing just to own it. So money flows away from silver and back toward yield-bearing assets. This is the double pressure that sent silver from its highs down to the $78 range. It was not one thing. It was the convergence of trade uncertainty and liquidity, tightening happening at the same time, creating a momentum that pulled prices lower. Now here is where I want to slow down, because this is the most important part of the whole video. The market's reaction to this convergence has been to treat the $78 level as evidence of something broken, as if silver's fundamentals have changed, as if the bull case for silver has been disproven. But when you actually look at what is happening beneath the surface, a very different picture starts to emerge. The industrial case for silver has not gone away. By most credible estimates, the silver supply-demand dynamic remains structurally tight. Mining output has not been growing fast enough to keep up with the accelerating adoption of solar energy globally. The energy transition, the move away from fossil fuels and toward clean energy, is not slowing down in any meaningful way. Governments around the world are doubling down on solar investment, and every solar panel needs silver. Electric vehicles continue to grow as a percentage of total car sales. The electronics sector continues to expand. The long-term demand story is still very much intact. On the supply side, silver mining is genuinely constrained. Many of the world's largest silver deposits have been in production for decades and are producing less per year than they used to. Discovering and bringing a new silver mine online takes years and enormous capital investment. So you have a situation where long-term demand is growing, supply growth is limited, and yet the price just had a significant pullback. That combination, strong underlying fundamentals meeting a short-term price dip driven by macro and geopolitical noise, is exactly the kind of setup that historically makes experienced market observers lean in and pay very close attention. Now, I want to talk about something that does not get enough attention in most silver conversations: the psychological dynamic of the market right now. Markets are not just made up of numbers. They are made up of people making decisions based on information, emotions, and stories. And the story dominating the silver market lately is a story of fear. Fear of trade wars, fear of slowing growth, fear of tight money. Fear, as we know, is one of the most powerful forces in financial markets. It causes people to sell assets they might otherwise hold. It causes prices to overshoot on the downside, going lower than the underlying fundamentals would suggest they should. This is not a new phenomenon. It has happened in silver before, and in virtually every other commodity market as well. Some of the biggest subsequent rallies in silver's history have come after periods of maximum fear and uncertainty. That does not mean every dip turns into a rally. It certainly does not. But it does mean that the current sentiment environment, while negative, is not necessarily a reliable guide to where silver goes over a longer time horizon. Think about it this way: If you only watch the news headlines, you would think silver is collapsing. But if you zoom out and look at what the world actually needs silver for over the next decade, the picture looks quite different. The world is not going to stop building solar panels because the US and China had a difficult round of trade negotiations. The demand for electronics is not going to evaporate because the Federal Reserve kept rates steady for another quarter. These are durable structural trends that will continue to play out regardless of the short-term noise. Now, I want to be fair and acknowledge the other side of this, because good analysis always considers risks. It is entirely possible that the trade situation between the US and China gets meaningfully worse before it gets better. A full-scale trade conflict with broad tariffs across a wide range of goods could genuinely slow global industrial production enough to weigh on silver demand for an extended period. That is a real risk. It is also possible that the liquidity pressure gets worse, that the Federal Reserve does not cut rates as quickly as many are hoping, or that some unexpected economic shock forces tight policy longer than expected. In that environment, financial demand for silver could remain weak even as industrial demand holds up. There is also the question of the US dollar. Silver, like most commodities, is priced in dollars. When the dollar strengthens, silver tends to fall, not because the metal is worth less in real terms, but because it costs fewer dollars to buy the same amount. A strong dollar environment, which we have seen persist in 2026, is an additional headwind for silver prices. And as long as the dollar remains strong, which depends on interest rate differentials between the US and other countries, this pressure is not going away overnight. So the honest picture is this. There are real reasons silver has pulled back, and there are also real reasons to question whether that pullback reflects the true long-term value of the metal. Both things are true at the same time, and sitting with that complexity is what good analysis actually requires. Hey, if you have found this breakdown useful so far, take just a second to hit the like button and subscribe to the channel. It genuinely helps this kind of content reach more people who are trying to make sense of complex markets without the noise and the hype. I put a lot of work into keeping these videos balanced and informative, and your support makes a real difference. Now let's keep going. One of the frameworks I find most useful when thinking about silver right now is what I call the signal versus noise test. You ask yourself, is the price movement I am seeing driven by something that changes the actual, real-world story of this asset? Or is it driven by temporary sentiment, uncertainty, and market psychology? For silver right now, most of the downward pressure is noise. The trade talk uncertainty is real, but trade talks between the US and China have been ongoing for years, and the direction, even if bumpy and slow, has generally been toward managed coexistence rather than complete economic decoupling. Neither country has a genuine interest in fully destroying their economic relationship. The U.S. needs Chinese manufacturing and supply chains that cannot be restructured overnight. China needs U.S. markets and technology. The underlying trajectory is probably not as catastrophic as the most bearish interpretations suggest. Similarly, the liquidity pressure, while real, is not permanent. Central banks operate in cycles. The current period of tightening will eventually give way to some degree of easing. When and how much is uncertain, but the direction is not fixed at tight money forever. And when liquidity conditions improve, assets like silver that have been beaten down tend to respond meaningfully. The signal, the real fundamental information about silver, continues to point toward a metal that is in structural demand growth, limited supply growth, and genuine industrial importance. That signal has not changed. What has changed is the short-term financial environment around it. Now let me bring this closer to home, because it is worth asking, how does any of this actually affect you? For most people watching this video, you are not professional traders. You are not sitting at a terminal watching silver futures all day. You are working a job, managing a budget, maybe setting aside some savings, maybe thinking about how to protect your purchasing power in an environment where inflation has been a real concern over the past few years. In that context, what does silver even represent? For a lot of everyday investors, silver has been part of a conversation about portfolio diversification. The idea that holding a mix of different asset types reduces the overall risk of your financial picture. Silver has historically had low correlation with stocks, meaning when stocks go down, silver does not always follow, and sometimes it goes the other way. In a world of economic uncertainty, that diversification value matters. But the $78 dip is a reminder that silver is not a smooth, stable, set-it-and-forget-it asset. It is volatile. It can move sharply in both directions, and if you hold silver, whether in physical form, in an ETF, or through mining stocks, you need to be psychologically prepared for that volatility. The people who get hurt most are the ones who bought at higher prices expecting a straight line up, then panic sell at lower prices when the dip arrives, locking in a loss. That pattern is essentially how the market transfers money from impatient hands to patient ones. The investors who do well in silver over long periods tend to be the ones who understand what they own and why they own it, who are not making decisions based on the last 3 days of price action, and who have thought carefully about what role silver plays in their broader financial picture. That is not a secret strategy. It is discipline combined with understanding. Now, let me tell you what to watch going forward, because I think this is genuinely useful. The most important thing to watch on the Trade Talk side is whether we start to see movement on the specific areas where the U.S. and China are most deeply at odds: technology transfer, rare earth minerals, semiconductors, and currency policy. If there is meaningful progress on any of those fronts, it sends a very different signal than the current stalemate. A genuine de-escalation of trade tensions would likely be a positive catalyst for silver, because it would reduce the uncertainty discount the market is currently pricing in. On the liquidity side, watch the Federal Reserve's communications carefully. Every time Fed officials speak about the path of interest rates, markets react. The question is not just what rates are right now, but what the market believes they will be 6 months from now. When expectations shift toward lower rates, because inflation has genuinely come down, or because the economy shows signs of slowing, that tends to be good for silver, because it reduces the opportunity cost of holding it versus yield-bearing alternatives. Also worth watching is the physical silver market, what is actually happening with coins, bars, and ETF holdings. When paper prices drop but physical demand holds strong, that divergence often resolves in favor of the physical market. Industrial users locking in supply contracts and central banks adding to precious metal reserves are signals of real-world demand that does not always show up immediately in the paper price. And finally, watch the dollar. The DXY, the U.S. dollar index that measures the greenback against a basket of major currencies, has been a powerful headwind for silver. If the dollar weakens, that alone can provide meaningful support for silver prices, even without any other changes in the macro picture. Let me bring this all together before we close out. What we have in the silver market right now is a situation where a real and legitimate price correction has been driven by the convergence of two powerful macro forces: U.S.-China trade uncertainty and global liquidity tightening. That correction has taken silver to around $78, and the market mood is clearly negative. People are calling it a crash. They are treating it as the end of silver's story. But when you look beneath the headlines, the underlying fundamentals of silver, the structural demand from the energy transition, the limited supply growth, the genuine industrial importance of the metal, those have not changed in any meaningful way. What has changed is the short-term macro environment, which is creating noise that sounds a lot louder than the actual signal. The $78 dip may or may not prove to be the bottom. Nobody knows that with certainty, and anyone who claims otherwise is overpromising. What is worth understanding is that the forces driving this dip are largely temporary and sentiment-driven, while the forces underpinning silver's long-term story are structural and durable. If you own silver, the most useful thing you can do right now is ask yourself whether your original thesis, the reason you bought it in the first place, has actually changed. If the answer is no, then the current volatility is noise, not signal. If you are thinking about silver for the first time, Do the work to understand what you're actually buying, what role it would play in your broader financial picture, and whether you have the patience to hold through exactly this kind of turbulence. The market trap at $78 is not a price trap. It is a psychological trap, the trap of letting short-term fear override long-term thinking, of selling on a dip driven by temporary uncertainty, of treating a moment of maximum noise as a revelation about the future. The investors who see through that trap are the ones who have taken the time to understand the big picture, which is exactly what you have done by watching this far. Thank you so much for spending this time with me today. If you found this video useful, please like it and share it with someone who is trying to make sense of the silver market right now, because good information matters more than ever in moments like this. Subscribe to John Smith 02 if you want to keep getting analysis like this. Markets, macro, and economic trends explained clearly for real people. Drop your questions or your take on silver in the comments below. I read every single one, and this community always has great insights. I will see you in the next video.